Yeah, evidence of the tariffs passing through. Joining us now with $1.8 trillion in assets under management is Empower Chief Investment Strategist Marta Norton. And we've got jpmorgan Asset Management Chief Market Strategist for the Americas, Gabriela Santos. Gabriela, let's begin with you. Pass-through of inflation, two more rate cuts, guaranteed or not? Because you cut rates if you think inflation is in check.
I think right now what we're seeing, as Chair Powell said, is a risk management exercise, just getting back to neutral, taking the foot off the brake. So pretty slow, pretty gradual. I think inflation is acting not as a stop sign to these rate cuts, but a speed bump. It keeps them going gradually. In terms of the pass-through of inflation, I think this is still up for debate. We do expect a little bit more inflation into the second quarter of next year as businesses pass this on. As an equity investor, I actually do want to see consumer price inflation pick up a little bit more, because that's a sign that U.S. businesses are able to share that tariff burden with their consumer, because right now they're absorbing it a lot on their margins. And especially if you're a small business, you have foreign importers, you don't have a lot of pricing power, that's something that could really squeeze your margins. And we think expectations are too high for small cap margins. Marta, one of the things we've seen is a weaker dollar. Tell us how to invest in this atmosphere. Not entirely sure we will get two more rate cuts at the two meetings left here. Could be one. We just don't know. So where do you put your money?
Well, it's kind of an interesting conundrum, because you have the rate cut cycle that we kicked off with September, but then of course you also have the valuation story, and you're getting, I guess if we're sticking with road analogies, you may be getting some yellow lights from valuations with them being so high across the board here in the US, and then we've also seen some valuation expansion overseas. Now, if we're talking globally and you're thinking about currencies, I think this idea of a lower dollar does make a case for having overseas exposure. Even if the valuations aren't as compelling over there, you are getting some currency diversification, and that can be a value in the current market environment. But overall, I would say, and this is kind of a tiresome idea, but I think this is a market that really does call for diversification, given the range of economic outcomes that we're looking at.
Okay, diversification away from and toward what?
Well, within the U.S., I wouldn't abandon the AI call. I mean, I think if I were to fall asleep and wake up in 10 years, I'd still want that in my portfolios. But I think you do want to look for those pockets of value. And one of them is small caps. And to your point, there is some evidence of rate sensitivity there, but there's real economic concerns too, related to their sensitivity to the environment. So I think you're going to want to play those off one another.
And Gabriela, cash-like rates. Anybody who has money parked in money markets, et cetera, those coming down.
25 basis points already.
So take money out of those and put it where?
And here's where stocks can continue to do well. We would agree that if you just look at large caps, valuations are expensive. So we like a mix of growth and value within U.S. equities, nice structural themes, including deregulation and AI. We also do like international stocks as another way to diversify it. And then the bond side, I think it's less of a cash or a long duration. It's a little bit more, what's the sweet spot, short duration, 2 to 3 years, preferring corporate debt to federal government debt.
It's great to have you both on an extraordinarily busy day. The widely expected 25 basis point cut has come. The question is, what's next?